Hi everybody, this is Hustle Hub. I'm Giacomo. Today I'm with Michael Ball. He has a newsletter on Substack. Michael Ball has a CFA and an FRM, so he's pretty qualified. So Michael, please introduce yourself for those who don't know you yet, and let's tell us a bit about your presentation and what you're going to talk about us today.
Sure, thank you. My background is mostly in macro policy. I spent the earlier part of my career at the New York Fed. I was fortunate enough to be there during the financial crisis, where I worked in the markets group, first at the discount window during the heavier days, and then for 3 years on the mortgage-backed security team. It was a great experience. It gave me a pretty broad overview of policy and the market monitoring kind of component that the Fed does, and then hence how they use it to kind of craft policy. More recently, I was a allocator for pensions and a fund-of-fund. And starting actually in March 2020, I worked at a small boutique macro fund for the prior head of macro research at ISI Evercore. Currently, I write a newsletter called Midday Macro on Substack. On this, we basically cover sort of the daily, weekly narrative in markets. We look at sort of technicals and optionality in the markets. I'll then do a deeper dive sort of on the more longer term flavor of where we're going. I do economic and like policy speakers recaps, and then we have some longer standing macro themes. Today's presentation is basically what I'm calling the good, the bad, and the ugly. It's just a way to sort of break down the current macro themes in the market, both on sort of a more US centric view, but also globally. With that said, just to rehash, there are 3 really good things going on right now in the US economy. The consumer is starting from a relatively strong place. The firm or corporations are generally in a healthier state, and the job market is still quite tight. I think when we look at the consumer, it's important to note that yes, spending is starting to slow down. We saw in the real consumer data yesterday, and as far as real consumption spending, that there was a negative print. A lot of this was due to a drag because of autos, but generally it is slowing, which goes in line with the narrative that we're hearing elsewhere. When we think about it, the consumer, as we know at this point, has been shifting from discretionary goods to staples as fuel and food prices have increased and taken away purchasing power for other things, and also generally away from goods into services. So discretionary services are still relatively strong, but there's signs of that starting to slow as well. I think the most interesting point more recently was the Q1 data for net household wealth actually turned lower. It was only mildly lower, I think, by 4 or 5 trillion because of losses in financial assets. And this was somewhat buffered by increases in housing as the housing stock prices, the price of housing went up, so the aggregate stock of value went up. Finally, there's a little more debate about this, but the amount of cash the actual consumer is holding is still high compared to pre-pandemic levels. Now, this isn't evenly distributed among different economic groups, meaning lower and middle class kind of consumers are under more stress and probably have less savings than would be thought. But it's important to note that the amount in of someone's checking account is still relatively high on aggregate. And when coupled with sort of the increased use of revolving credit, the consumers found ways to stay kind of healthy and even with their purchasing power. And turning to the labor market, as we said, it's actually quite tight. The saying that there's 2 openings for every 1 job seeker still seems to be pretty applicable. When we look at the spider graph on the left, it shows that pretty much every measure of the job market is stronger than it was pre-pandemic at this point, except for the participation rate. This was one of the reasons the Fed finds itself so far behind the curve, because in the end of last year, they were perplexed by the fact that they were still missing millions of workers from the workforce. And it caused them to prioritize the full employment mandate over price stability. And as we know now, about 6 months later, they're playing catch up pretty quickly as they reprioritize price stability. On the right, you can see the job openings has sort of plateaued. And if you look at Indeed, which is sort of a leading indicator, it's starting to kind of come down. This would make sense. We're seeing this in a lot of the regional surveys and also in the ISM PMIs. The shortage of workers is still sort of industry to industry, sector to sector, meaning that qualified workers can be hard to find in certain places in certain types of businesses. But generally, that kind of gap that was very prevalent last year has been filled. And then that supply side sort of pressure to inflation is slowly coming off as intentions to raise wages or intentions to hire just more generally have cooled. And finally, we look at the balance sheet of corporations or the firm more generally, and we see that basically they used the lower rate environment over the last 2 years and a lot of the stimulus money to sort of shore up their debt levels and to either pay off debt or to kind of restructure into more favorable ways. So the actual interest rate coverage has improved greatly. When you look at like NFIB small business surveys, almost 98% of businesses are reporting they have easy access to credit. And when we kind of listen to the banks, the issue isn't so much supply of credit. They're more than happy to increase their C&I kind of books. They just don't have the demand. And that's been sort of an interesting kind of takeaway, whereas the system's been pretty flush and there hasn't been a need really for that credit to drive growth. And that obviously could be changing, but right now as it stands, the balance sheets sort of in the private sector business is relatively healthy historically. Turning to the bad, there's a couple of things we want to highlight. I think first and foremost is inflation. Clearly, we all know that story by now. I think it was interesting to see that the PCE deflator came down again for last month, but we saw yesterday. It's now at 0.3% monthly gains for about 4 months in a row, which is giving it an annualized kind of rate of closer to 3.5, which is encouraging. But obviously headline inflation, especially CPI, is grabbing sort of all the attention. And clearly, as we saw with the 75 basis point hike, is what the Fed is focused on. I would add that the breadth of inflation has been quite impressive. So we're no longer just seeing a few categories kind of driving the rise. It's now very well established across multiple sectors, multiple categories, excuse me. And finally, I think although we are peaking, the one area that is problematic and will be something the Fed has to consider is the housing component. Now, housing itself, and as we will talk to, is slowing, and the activity in as far as boots on the ground is clearly contracting. The actual price appreciation is still quite high, and we've seen that in the most recent data, even as of last month, in some of the other housing data. But with the PCE deflator for housing itself rising 0.6, I think that's a real problem for the Fed, and it continues to cause sort of a division of good coming down and basically, people shifting to services, but in housing itself still being quite the influencer on inflation. Supply chain pressures are another bad. This has clearly peaked as well, as we know now that demand for durable goods has come down. But it is still at high elevated levels. And although we're seeing shipping costs come down, we're seeing trucking, freight rates come down, and actual overall activity contracting, it's coming off a very high level of problematic, multi-problematic level. Interestingly, and worth noting that the shutdowns in China, because of the zero COVID policy, are taking longer sort of to work their way through the supply chain disruption channels than the original pandemic shutdowns did. And then in the recent sort of round of regional Fed manufacturing surveys, and again, in sort of today's even ISM manufacturing PMIs, it was noted that supply delivery times had risen and that logistical issues were continuing longer than expected. Finally, again, this is what we were just speaking to, the China zero COVID slowdown. Now, China's got themselves sort of in a corner here. And as a result, of not being able to sort of back off this policy and still being months away from a sort of real vaccine solution, the driver of growth globally that has been so strong over the last decade has really been sidelined. And it's kind of hard to get a beat on exactly where things can go, given how precarious things are there on the ground, meaning that, things can shut down quite quickly again. And Xi and Beijing have made it clear that this is the priority over growth. So we're hopeful that, the worst of that is behind. And as far as its effects on inflation, that's also going to now be more of a deflator, because now they're going to find themselves sort of exporting deflation as they want to ramp up capacity in manufacturing to, work on bringing down unemployment. And, they have a cheaper currency and they're going to have excess inventory that they're going to want to push out. And all that, along with the fact that we have falling demand here for durable goods, should be a deflationary factor in the second half of this year. But with that said, it's all very uncertain because at any moment, an outbreak could shut down Shanghai again or other parts of the kind of country. and have an unknown economic effect on not only the Chinese, but on, the general global state. I would add, though, that they have been reluctant to add too much stimulus. They can't do so much with the PBOC because of the peg and the fact that the Fed is in a rate hiking cycle. But even on the more municipal, local fiscal level, they still kind of held back. I would expect this to change going into the second half as the zero COVID policy becomes a little bit further away from priority. Right now, any sort of stimulus kind of is going to hit a wall if consumers aren't allowed to go out anyway. So it's almost wasted money, or it's just pent up money that has yet to be properly kind of, the multiplier is just not there yet, I guess is the best way to look at it. Finally, in bad, the US housing market. The housing market, again, is coming from a very strong position, but it is clearly decelerating. Affordability became problematic at the turn of the year and now has only gotten worse with higher mortgage rates. And it's been quite an impressive rise there. As you can see from the charts, the MBA US Purchase Index has kind of completely rolled over back to almost pandemic lows. And the NHAB Housing Market Index, which kind of looks at foot traffic and intentions to buy, is starting to roll over very hard. So, every day in the financial media, you bring new stories of people rushing to sell, and then this should be, sort of bringing pricing down, which is a good thing. But on the other hand, it's also going to start to affect net wealth and also the wealth channel, which gives people confidence to go out and spend. Finally, in bad, actually, and this is kind of bringing all the stuff together, is the tightening Fed policy. This is not only Fed policy, actually, excuse me, this is also the fiscal policy. So tax receipts this year were massively higher, which in some ways is a good thing because it showed a profitability on both household and kind of business levels. But that is a drain sort of from, the system. And obviously, benefit receipts have fallen drastically as the pandemic measures have worn off. Switching to monetary policy, financial conditions continue to tighten. I think this is a well-known story at this point, and we write about it often because this is really the driving factor. The Fed has been jawboning the market now for about a year and a half, trying to get things, a little bit tighter there initially, but now finding themselves behind the curve and almost overcompensating, which has to do a lot with the recent market routes. Every time a certain Fed official would come out saying they're prioritizing price stability, making no mention of financial market damages, and actively seeking to alter the wealth effect channel to bring demand down, you see the S&P fall, and until recently, you've seen sort of yields rise, and both of those together indicated higher volatility levels, which have tightened financial conditions. The Fed is actively targeting this index. And at this point, it's very hard to say when they're going to be satisfied because they're clearly not concerned with losses yet, even though we're in correction territory. Now we get to the ugly. The Ukraine war is clearly first and foremost there. We just don't know the tail risk that's involved here. There's obviously been an inflationary push from this, whether it's in the food or energy channels. Europe's experiencing worse than America. But I think it's also important to really just put it in the ugly category because we just don't know if it can escalate and how much worse things can get. Now, with NATO and the European Union sort of backing Ukraine and increasingly supplying them with military weapons, and Russia obviously digging its heels in and now trying to hold back food and energy, the chances of a further escalation to another part of Europe or another, expansion in the other Ukraine areas, because obviously right now we're just on the sort of eastern part of Ukraine, is very real. I'm not really sure how to even quantify this. It's just something I think we have to put in the ugly as, until this sort of ends, which is very uncertain as well, it has the potential to have a very negative tail risk. And as you can see in the chart on the right, we've already had quite a kind of shock to the system from the food and from the energy channels as well now. Finally, the US-China relationships are in the ugly category simply from the fact they also have a large tail risk. Currently we are doing a lot of business together still. It's very clear in the trade data, but the kind of saber rattling rhetoric has only kind of picked up. And as far as Congress is concerned, it's the one area where you see bipartisan cooperation, or the strongest area, I should say. It's been interesting to kind of see the wolf warrior mentality coming out of Beijing during the zero COVID policy increase to try to offset the economic drag that's currently occurring there. It makes sense in a lot of ways to stir up nationalistic fervor when you have an economy that's slowing, unemployment rising, and as a result, you have people and kind of unrest growing. On the other side, the U.S. Clearly sees China as a threat, and recent actions by NATO also kind of exacerbated that kind of terminology. So look, I don't think Taiwan's going to be invaded tomorrow. I don't think China's in a place to push on the physical field, but it's certainly something in the back of the minds and in the back of investor minds. Although contrarily, you have seen some flows of foreign capital back into China recently, which is a positive sign. So in summary, I guess the best way to say it is the good things are getting worse. The bad things are improving, except for housing, but housing is coming from a very high level, and the ugly remain highly uncertain. In the charts here, you can see that bear markets have all been highly varied. We stand now at almost a 22% correction on the S&P, and this sort of puts us kind of on the further tail of losses for a recession. It again is a very unique situation where we have a Fed that's going to be tightening into sort of slowing demand, and there's a lot of rules that were in place before, like for example, if ISM was a negative print, the Fed has never raised rates. Well, that just got thrown out today when ISM went to a negative for manufacturing, and service sector is probably going to be approaching 50. On top of that, the yield curve, which is always a favorite indicator, has yet to sort of invert as far as the front end versus say a 10-year, but parts of the other yield curve are inverted. So I guess what I'm trying to say is I believe we are in a recession. I believe Q2 will technically be a negative print, and after the Q1 negative print, that puts us in a technical recession, even with consumption still being relatively strong, albeit slowing. But the second half of this year, I think, will cement that. And I think we'll finally start to get some clearer indicators that this will be a shallower, but still pronounced recession, meaning that it could go on for 3 or 4 quarters. Again, this is what I just said. We are already in recession. The hard data will now weaken, and the soft data will probably base and improve into year end. So why do I think that the soft data like consumer confidence and business confidence will start to improve? Because that's mostly been driven by inflation. And I believe inflation is actually peaking, although it's still very high and needs a long way to go before the Fed will be satisfied. I think what we're seeing in the commodity markets, what I expect to see in future PPI prints, producer price prints, and what eventually will hit the PC and CPI prints maybe into the fourth quarter, will kind of demonstrate that the sort of supply side slash, I guess, cost push inflationary pulse, which makes up around 2/3 of the inflationary story, according to kind of recent work done by the San Francisco Fed, and where I'm in total agreement with. I think we're generally seeing improvements enough there, and although we're at elevated levels, this will come down, and as a result, the softer data, which is more survey-based and more emotional, will start to improve as the Fed begins to show that they are getting comfortable with that trend of inflation coming down, and hence their tightening cycle will end. And as a result, we'll start to actually cut rates in the second half of next year. And that's what we're seeing now in the Fed funds future market, where it varies day to day, but there's about 100 basis points of cuts from next year's summer to 2024 summer. This may change, may tighten, may not, but clearly the markets are seeing where a peak rate around 3.5 on the Fed funds is now, and are becoming more comfortable with the idea of the Fed cutting rates at the second half of next year. So again, what we spoke to, a shallower and shorter in duration as far as the recession, due to the strength of households and businesses, the tighter labor market, and then the expectation that policy is going to be peaking and becoming more easing. Have markets correctly discounted this is the real question. We haven't seen earnings sort of roll over yet, earning expectations, excuse me. We've seen earnings start to slow clearly in Q1, and we'll expect to see that as we enter the Q2 season. What we really need to see is sort of sell side and expectations for earnings to go almost negative to signal then that the valuations in markets are correct. So talking about a PE right now is a little bit, it doesn't make a lot of sense when your earnings is still artificially high. But I believe sort of in somewhere in the third quarter, that's going to come crashing down, as we've now seen with sort of our economic projections and a lot of sell side shops and economists lowering their growth expectations, not only for this year, next year, but also as far as 2024. Finally, I said back to the soft data, you've seen consumer sentiment come completely detached from the employment situation. My expectations, again, is when inflation starts to fall in the second half of this year, consumer to become more confident, which will be a driving force of next year. But also, the labor market will be, shedding some jobs, and unemployment rate may be going up. But given the strength we've seen there, there should be a meet in the middle where we don't see a complete deterioration in labor and we don't see a further weakening in consumer confidence, and the two sort of come together in a more organic fashion. So again, Fed's convinced the market that they are going to create a recession. This is already sort of priced in. I think it's becoming sort of gospel now to say that people are convinced the Fed is going to create a recession. Markets have priced this into assets already, as you've seen sort of with the first half of this year being one of the worst halves since the 70s for equities. Hard data will catch up to the soft data weakness in the second half of this year. That's starting to already happen, although the hard data has held up strongly. The slowdown should be shallow, given no further shocks, given the strengths we've spoken to. And the weaker the data gets and the faster it gets weak, the quicker the pressure will come off the Fed to tighten further. And as a result, we can get to a more organic level. I think next year will really be about trying to find the steady state of the neutral rate and looking at sort of the more organic, back to the basics, right? We've had a shock to the system from the pandemic. And then we have a shock to the system from the stimulus. Now we have to get to, back to a productivity demographic kind of story. Like, what are we capable of in the long run to support earnings? And have more nuanced stories and sectors and sort of individual companies versus this kind of tied up, tied down trading that's been really occurring lately with high levels of volatility and general, liquidity leaving the system, which is exacerbating all of that. So that's sort of it. I know there's much more to say, but keep things kind of basic. This is kind of where I want to stop and just say these are my big kind of macro themes.
Okay. The first question I wanna ask you is, can you make a little bit of a outlook on the major central banks policies aside from the Fed, and have they did they take a similar policy to the Fed, or are there some major central banks that are doing something different?
Sure. So I think initially there was a very similar policy response and a good coordination in 2020. I think now there has been some sort of changes. Obviously, the BOJ is still very much on the sideline and happy to keep policy ultra easy. You've seen the ECB have to change more recently in the last couple of months, with sort of expectations there still on the more dovish side as far as the G7 community. The Bank of England has gone at a much more steady pace, even though they've had higher inflation, because unfortunately their economic drag is much deeper, and maybe Brexit and other things they talk through there, but keeping it simple, they are a much more linear path versus the Fed, which threw in the 75 basis points after the 50, after the 25, and is expected to, put in another 75 and potentially 3 more 50s before hitting sort of the 3.5 range area. What does this mean? Well, we're seeing it reflected. I mean, the dollar is relatively strong because of this differential in rate expectations. And also, we're expecting here to see sort of inflation maybe come down faster. Now, we know that from market-derived pricing. We have yet to sort of see it in the actual, spot levels. So again, ECB and sort of the BOE are on the middle range, the BOJ super dovish, and the Fed is becoming one of the more hawkish ones. I think just finally to finish the thought, tightening in central banks elsewhere has been actually more aggressive. And, we can do a whole show on emerging market central banks, but there's an interesting thing being set up there where they're ahead of sort of the curve. So if this is a global inflationary pulse that comes down together, a lot of places like the Brazils and some of the other emerging market, like kind of juggernauts, are going to be able to cut rates much quicker. But again, that's a whole nother subject.
Okay. Another question that I have is, can you explain what is your point on the recent oil price moves? Because a lot of people, given the fact that we had a recent drop in the price compared to the highs we had in the last weeks, what does that signal to you? A lot of people say that okay, maybe tensions are not as high as a week ago, or they're completely wrong.
Right.
But there are a lot of people on the other side that say the recent oil price drop means that a recession is more likely. What is your point on that?
Yeah, so I think it's interesting, and there's a lot to say to oil, and you want to be careful because you really want to listen to oil analysts. It's a very technical market now from the perspective that it is being driven by basically gas and diesel. And what I mean by that is oil at 110 today, somewhere in that range, give or take $10 on WTI, is not actually problematic to economic growth. But gas and diesel are reflecting an oil price that's much higher. And I don't want to speculate, but let's just say 200 to be, a little sensational. At $200 in oil, economic activity pretty much implodes because it's just too much of a tax on the consumer. So right now, as we sit, diesel and gas are really a giant burden and drag on economic growth. So demand destruction is clearly occurring. Now, what we've seen sort of in the weeds is sort of crack spreads and time spreads have shifted a little bit in the last couple of weeks to kind of question whether demand is going to be staying there at its current levels, or whether we've now got to a point where growth will be slowing in the next half a year to have organic destruction of demand. Interestingly, with China's lockdowns in the second quarter, oil kind of got a little bit of a break there. And now China will probably be the marginal sort of determiner of where spot oil goes and how that future curve looks. Whereas in the US, I think as we get through the driving season and we get into the winter, interestingly enough, you could see probably less demand needs and hence the curve reflecting that. And also to kind of finish the thought on gas and diesel, I saw something like refining capacity is at 98%. It's multi-decade high. Now, I could be a little off here where that kind of time history is for the last time we were at this level of capacity. But the refiners are kind of operating as much as they can, and we're slowly making some dents into this massive inventory shortage we had. Now, we're still well below a 5-year historical norm. If you look at an IEA kind of chart and you dig into the data, there's still much more to do. I'm just a little more confident that at least now the trend isn't getting worse, meaning that the inventory draws aren't getting worse. And I think the SPRs helped with the oil front. And I think now the sort of refiners have stepped up a little bit as much as possible on the gasoline and diesel front. Now, again, there's a lot to say about the energy market. Russia was a massive supplier of diesel. And funny enough, nat gas is sort of, to switch gears slightly, fallen off kind of a cliff on our markets because of our export channels being impaired by some disruptions, which will then also help U.S. consumers, indirectly, and bring down inflation, which I think next month's print is going to reflect a gasoline price at the pump falling and nat gas energy costs for housing falling. So, there is positive signs that we could have potentially tactically peaked. Longer term, oil is going to be in trouble, and I think supply and demand, because of the lack of capex, which is a multi-year story that is well known, is still going to keep oil pretty well bid. I just think right now the sort of initial shock of the Ukraine war push, and now kind of the concerns, that there isn't enough, are starting to come off low. So that's what the last couple of weeks to me have been about.
Okay. And another thing that I'm worried about, and I think a lot of people are worried about, is contagion, because a lot of times recessions start in a specific country or area, and then it spreads out. What are the regions that worry you more than others? Is it Europe because it's so exposed to the commodity prices, or is there somewhere else you're looking at?
Yeah, I think, it's pretty well established that the expectations for European growth is going to be lower because of the energy cost drag. I'm more confident than most in China's ability to sort of re-stimulate, especially with the political situation in November for Xi going for his third term, wanting to look good into that, probably wanting to announce some pretty significant policies following that to set the tone. So I am less worried about that. They're also going to luckily have their mRNA vaccine somewhere in the winter, which will then stop the zero COVID uncertainty and probably boost confidence again, because that's been one of the bigger drags there. Although people are out and about again in China, the confidence level that that's going to be able to last and they're not going to be locked down again is very low. As far as the US, I think, again, the sad story, which is going to be hard for markets to gravitate towards, is the quicker things slow down and the more the labor market sort of freezes and contracts and becomes less tight. When I say freeze, I mean, it doesn't need to shed a lot of jobs. It just needs to sort of stop hiring. And the JOLTS data, which shows openings, needs to come down. that'll give the Fed the confidence, on top of all the other things we've talked about from sort of the supply side, that inflation will be meaningfully trending down to target by the end of next year. And as soon as that happens, then we can sort of normalize policy to a more neutral level instead of now the overshoot that they seem to be orchestrating. And as a result, businesses, consumers can sort of just get back to a more organic growth level, which I still think is somewhere around 1.5 to 2.5. Nothing spectacular, but sort of along with our demographics and our productivity levels is just what's sustainably needed. I mean, keep in mind the growth levels from from 20 to 21 to now. I mean, I think we went from 10, 11% to a 5% now to maybe a negative this year. These are just unsustainable in way for businesses to make decisions, for consumers to feel confident. And this is all about inflation. So to kill inflation, you have to almost kill the economy, which is what the Fed is trying to jawbone it into. And as soon as that happens, then things can kind of level out and start to rebuild at a more normal level. So I'm confident that that'll happen. It's just not going to be anything as spectacular as the last 2 years of growth had, because we're just overstimulated the economy.
Okay. And the last question I want to ask, and it mentions one of the things you just said. Do you think, is there a point where, for example, the Fed is willing to let inflation go higher in order to have the economy back up, going and growing hard?
Yeah, so when the Fed rewrote their long-term goals in 2019, this was after the Fed Listens sort of exercise where they went out to more regional Feds and spoke to businesses and got a sense that prioritizing maximum employment along with price stability was the more effective policy for economic growth. Again, as I said, sort of during the pandemic, they prioritized the labor component, and labor came back, or excuse me, jobs came back much stronger than expected. And due to the supply side shocks, inflation came back a lot stronger. And it wasn't necessarily demand driven, although demand did play a significant part. It was just simply that they allowed sort of a focus on labor to allow them to fall behind the curve. So I don't think we're in any regime like that currently until we see inflation again back in a 2-3% target range, or excuse me, spot range on core PCE. But the future, and where I think policy for both fiscal and monetary is going, is becoming much more ESG focused. And I put out some research on this, and it's interesting when you look at pre-pandemic speeches to see how much emphasis is put on social and environmental causes. This is a real risk. Now, it's not necessarily a bad thing, and I certainly don't frown upon people wanting to make the world better, but price stability really is the main purpose of central banks in this fiat currency regime. So for them to deter from that is very dangerous, because it becomes a tax on the citizens of the country anyway, right? So right now, inflation is hurting the very people the Fed were trying to focus on pre-pandemic the most. So again, to answer your question directly, yes, I think the pendulum will swing once we get through the next couple of years of bringing inflation back into more of a tighter range, back to prioritizing markets, labor markets, excuse me. And, they have a number of metrics they've spoken to, whether it's minority unemployment levels, whether it's the EPOP population that they, total participation pop that they want to bring in. This has been something Brainerd's been very focused on, and she's written a lot about, for anyone who wants to sort of get that sense. And I'd go back to the 2018-19 speeches and even the 2020 speeches.
Okay. Last thing I want to say is you mentioned the ESG, but probably do you think is there something like a long-term trajectory, sort of long-term benefit we're going to get out of the price hikes in the last few months, because more people are willing to invest in renewables, and it's something like a pain we have to go through in order to get to more renewable energy?
Yeah, I mean, look, every crisis gets some sort of response that has a longer term benefit in general to allow that crisis not to occur as badly again, in theory. Now, two interesting points to bring. I think the united effort globally to sanction and kind of bring Russia back out of the global economy, or I shouldn't say back out of, because it was the USSR that wasn't in it. But I guess my point being is we're now sort of in a Cold War mentality with Russia. whether it's Europe and America, but also other parts around the world, has kind of boosted China's effort to up their renewable game, with them putting tons of solar and tons of other sort of initiatives in place. So one of the big stimulus things in effect there on the fiscal front, coming at a more national level and not from more of a municipal province level, is this renewable energy push as part of their dual circulation kind of goals. And dual circulation is Xi's goal to get their economy off Western inputs, whether it's semiconductors or imports of commodities. China, as we know, and India following second, have the largest populations and have somewhat of the largest carbon footprints, although America has a very large carbon footprint as well, and per capita larger. But, to answer your question, the war in Ukraine and the price and shock that occurred in energy has actually expedited China's renewable push. It also has, helped America and Europe realize that they can't rely on fossil fuels from unsecured locations. Look, I haven't seen the numbers because right now we're sort of in the earlier stages of it, and these are multi-year and multi-decade initiatives. But the expectations are this would increase investments in renewables, because at higher, fossil fuel prices, you're more incentivized to do that. So yeah, I think that's happening. And the question is, can we get regulation to work? Because right now in America, regulation is getting in the way of a lot of fossil fuel initiatives, but also renewable initiatives. And as far as Europe, is there coherent, collaborative fiscal policy that can equally see it over the continent? And how long will it take? And if things correct, and let's say for whatever reason there's a de-escalation in Ukraine war, now India and China are taking more oil from Russia. Maybe Europe finds alternative sources. Have we realigned and hence prices come down? Do you have the incentives then reduced? Because what you really need to ensure is that you stay the course, and it's a multi-decade course.
Yeah. So I'm done with the questions. Thank you a lot, Michael, for your research, your contribution, and great presentation, and great. Thank you for quoting one of the best movies, I think, of all time. So thank you a lot, Michael. If you have anything else you want to add, you're free to do so.
Thanks for having me.
I really want to think.
No, thanks for having me. Always appreciate your show and your channel. If you guys viewers are interested, please go to my Substack. It's middaymacro.substack.com. I try and write twice a week. Again, it's bigger picture macro themes. And, I'm always open to emails or questions, so feel free to reach out to me as well.
Okay. Link will be in the description. Okay. So this is it for today. I'm Giacomo. This is Hustle Hub. See you next time.